Hey there, future financial gurus. Welcome to Teen Invest, your go-to channel for all things finance. Let's play a game today. Imagine you roll a dice. If you roll 1, 2, 3 and 4, you double your money. But if you roll 5 and 6, you lose all your money. Well, investing is kind of like that. Except you don't have to gamble. It's all about managing risk. Today, I'm going to show you how to invest smartly without getting burned. We'll talk about how to protect your money from big losses, how to build a balanced portfolio, and why slow and steady wins the race. So get ready, let's get started. Alright, so what is risk? Risk is the chance that your investment's value will go up or down. And trust me, it will go up and down a lot. That's just how the market works. There are different types of risk, but the biggest one most investors face is the market risk, which means that price fluctuates based on economic trends, company performances, and investor emotions. But don't worry, you can manage risk. How? By using smart strategies like asset allocation and rebalancing. Let's break them down. Picture this, you're at an all-you-can-eat buffet. Would you fill your plate with just pizza? Probably not, right? You would want a balanced meal. Some protein, some veggies and some dessert. Investing works the same way. You don't want to pull all your money into one type of investment. That's where asset allocation comes in. It's all about spreading your investments across different categories like stocks, which have high risk and high return, bonds, which have lower risk and steady returns, and real estate, which is suitable for stable long-term growth. This way, even if one investment does poorly, the others can help balance things out. Smart, right? The 100 minus age rule is an easy way to figure out your asset allocation. Let's say you're 25 years old. 100 minus 25 is 75 years. Therefore, 75% of your asset should go into stocks for growth. The remaining 25% should go into safer investment options like bonds and real estate. As you grow older, you need to shift most of your assets into safer investments. Why? Because when you're young, you can afford to take more risks. As you grow older and closer to retirement, you want less roller coaster action and more stability. Ever started a workout routine, then skipped the gym for a month? Yeah, things get out of balance fast. The same thing happens with investing. Let's say you started with 60% stocks and 40% bonds. Over time, if your stocks do well, you might end up with 70% stocks and only 30% bonds, which is riskier than what you planned before. Rebalancing is like a financial workout routine. You sell some stocks and buy more bonds to bring things back to your target balance. This keeps your portfolio in shape. Ever heard of dollar cost averaging? It's a fancy term for investing a fixed amount regularly, no matter what the market is doing. This is basically the SIP for the share market. Instead of freaking out over market's ups and downs, you just have to keep buying consistently. Sometimes at a high price and sometimes at lower prices. Over time, your cost per share averages out and you don't have to stress about timing the market. Investing isn't a get-rich-quick scheme. Some years your assets may go up 15%, but some years it may come down 10%. That's totally normal. The key is long-term growth. Focus on the bigger picture and you'll be surprised at what patience can do. Before making an investment, always ask, what's the potential gain and what's the potential loss? If the stock can go up 20% but also come down 10%, that's a 1:2 risk-reward ratio, which is a solid deal if you ask me. Always weigh the risk and reward before making an investment. So, remember the dice rolls from the beginning? Well, now you know how to tilt the odds in your favor. Risk is always part of investing, but with smart strategies like asset allocation, rebalancing and dollar cost averaging, you can manage risk and build long-term wealth.